So, how does a subject to sale actually work? Let's break down the process step by step so you can understand exactly what's involved in this type of real estate transaction. We'll cover everything from the initial agreement to the ongoing responsibilities. First, you and the buyer need to come to an agreement on the terms of the sale. This includes the sale price, of course, who is responsible for paying which closing costs and other fees, and, crucially, how much cash, if any, you will receive upfront for the equity you have in the property. This equity payment is a key part of the negotiation. It's absolutely essential that everything is documented in writing. A simple handshake agreement isn't enough to protect either party. To ensure the agreement is legally sound, a qualified real estate attorney or an experienced title company should be involved in drafting the contract. The contract must clearly and explicitly state that the buyer is taking over the property subject to your existing mortgage loan and outline all responsibilities. At the closing, which is a formal meeting to finalize the transfer, you will sign over the property deed to the buyer. Simultaneously, the buyer will provide you with any agreed-upon cash payment for your equity in the property. Following the closing, the title company will officially record the new deed with the local authorities, thereby legally transferring ownership of the property to the buyer. The buyer then needs to establish a reliable system, often by using a third-party mortgage servicing company, to ensure that your existing mortgage payments are made consistently and on time. From that point forward, the buyer assumes responsibility for managing and maintaining the property. However, it's important to remember that the original loan remains in your name until it is either fully paid off or refinanced by the buyer. The buyer has the freedom to decide how to use the property. They might choose to live in the house themselves, rent it out to tenants, or even put it back on the market and sell it to someone else at a later date. Your primary concern moving forward is ensuring that the buyer consistently makes those mortgage payments on time. If they uphold their end of the agreement, you can effectively free yourself from the burdens and headaches associated with the property. However, if they fail to make the payments, you remain legally responsible for the loan and could face potential financial repercussions. This is precisely why having a rock-solid contract and working with a trustworthy and reliable buyer are absolutely essential for a successful subject-to-sale. Why would a seller choose subject-to? Speed. These deals can close in days, not months, since there's no waiting for a new loan. You avoid agent commissions and repairs, saving thousands. Many buyers are investors who'll take the property as is. If you're facing foreclosure, subject-to can stop the process, save your credit, and get your loan current. You might even get a better price if your existing loan has a low interest rate. Investors love that. In slow markets, this can help you capture more equity. Subject-to is a lifeline for sellers who need out fast or can't sell the traditional way. It's about solving problems quickly and keeping your financial future intact. For the right seller, it's a win-win. Now let's talk about the big risk, the due on sale clause. Most mortgages say the lender can demand full payment if you transfer the title. Selling subject-to technically violates this clause. In reality, banks rarely call the loan due if payments are made on time, they just want their money. The risk is low, but it's not zero. If the bank finds out and wants the loan paid off, the buyer must act fast to refinance or sell. This is why you need a plan in place and a buyer who understands the risks. The due on sale clause is the main reason some sellers hesitate, but with the right precautions it's manageable. Know the risk, plan for it, and you can use subject-to safely. When does the due on sale clause actually become a problem? It's a question many homeowners face when considering creative financing options. Let's delve into the scenarios where this clause can turn into a significant hurdle. The biggest trigger: missed payments. When payments are not made on time or not made at all, it raises a red flag. If the buyer stops paying, the bank investigates and may discover the title transfer. Lenders have ways of uncovering these transfers, especially when payments cease. Another trigger: changing the homeowner's insurance to the new owner's name, which can alert the lender. Insurance companies often notify the lender of any changes to the policy. If the bank calls the loan due, you're still responsible for the debt, even though you no longer own the house. This is because the loan is still in your name. That's a nightmare scenario. It can lead to severe financial repercussions and immense stress. This is why working with a professional, experienced buyer is critical. They understand the intricacies of these transactions. Good investors have systems to ensure payments are made and backup plans if the bank calls the loan. They're prepared for any eventuality. Amateurs or dishonest buyers put you at risk. Their lack of experience or integrity can jeopardize your financial well-being. Always check the buyer's track record and have safeguards in your contract. These clauses can protect you if the buyer defaults. The due on sale clause is only a real problem if the buyer fails to perform. When the buyer upholds their end of the agreement, the risk is minimized. Protect yourself by choosing the right partner. A trustworthy partner is your best defense. Don't skip due diligence. Your credit depends on it. Thoroughly investigate the buyer before proceeding. The right buyer makes all the difference. They can turn a potentially risky situation into a successful transaction. How do you protect yourself? With a strong contract. Your agreement should make the buyer legally responsible for all payments: mortgage, taxes, insurance, and HOA fees. Include a performance clause. If the buyer defaults, you get the property back. Address the due on sale clause. Require the buyer to refinance or pay off the loan if the bank calls it due. Use a reputable title company or attorney for closing. After the sale, use a third-party loan servicing company to handle payments and provide proof. This creates a clear record and protects you if there's ever a dispute. These steps turn a risky deal into a manageable one. Don't cut corners. Legal protection is everything and subject to deals. Peace of mind is worth the extra effort. So, is selling subject to right for you? It's ideal if you need to sell fast, avoid foreclosure, or can't afford repairs. If you have lots of equity and time, a traditional sale may be better. Assess your situation honestly. Subject to is a powerful tool, but not for everyone. The main risk is the due on sale clause, but with a strong contract and the right buyer, it's manageable. Don't let fear of the unknown stop you if this fits your needs. Do your homework, get everything in writing, and work with pros. For the right seller, subject to can be a game changer.